Why do we try to predict the future? Some consult astrologers, others tarot cards. Humans have always been fascinated by the idea of knowing what lies ahead. It's a quest for certainty in an uncertain world. In the world of finance, we have economic data. This data acts as our modern-day crystal ball, offering glimpses into potential future trends. Imagine knowing which way the stock market will swing or when is the best time to buy a house. Such insights can be incredibly valuable. By analyzing patterns and data, economists can make educated predictions about future market behaviors. Now let's be clear, no crystal ball exists. Predicting the future with absolute certainty is impossible. But just like a detective follows clues, we can use economic data to make educated guesses about the future. This isn't just for Wall Street hotshots. Everyday people can benefit from understanding economic trends. Knowing if the economy is speeding up or slowing down helps everyone. It can influence decisions on spending, saving, and investing. Are you thinking about asking for a raise, starting a business? Understanding economic conditions can guide your timing and strategy. Economies speak in numbers. These numbers tell stories about the health and direction of a country's financial well-being. Fortunately, you don't need a PhD to understand them. With a bit of guidance, anyone can grasp the basics. Let's start with the basics. Gross domestic product, or GDP. This is one of the most important indicators. Think of it as a country's economic report card. It measures the total value of all goods and services produced. A rising GDP generally means more jobs and more money flowing. It indicates economic growth. Next, we have the unemployment rate. This is a crucial metric for understanding the labor market. This tells us how many people are actively looking for work but can't find it. High unemployment can lead to economic issues. Inflation measures how much prices for goods and services are rising. Imagine a grocery bill that keeps getting higher despite buying the same items. That's inflation at work. These basics form the foundation of economic analysis. Understanding them can help you make informed decisions. Now let's talk about how to use this data effectively in your decision-making process. Understanding the rhythm of the market is crucial for making informed choices. One simple method is trend analysis, which involves looking at historical data to identify patterns. Imagine plotting the price of coffee each month on a graph. This visual representation can help you see how prices have changed over time. Do you see an upward or downward slope? That's a trend. Recognizing these trends can help predict future movements. Regression analysis is a bit more complex, but imagine drawing a line through a scatter plot of data points. This line helps identify the general direction of the data. This line helps us understand the relationship between two variables, like interest rates and housing prices. Remember, these are just tools. No single method is foolproof. The key is to use a combination of techniques and common sense. Ready to put on your analyst hat? Start with reliable sources of economic data, like government websites or reputable financial news outlets. Don't get overwhelmed by jargon. Focus on understanding the core concepts we've discussed. Mastering economic data analysis takes time and practice. Start small, focus on one or two indicators, and gradually expand your knowledge.